Heya Cryptozens, welcome back to the Crypto Overnighter. My name is Nikodemus and we do crypto news analysis nightly at 10 p.m. And keep in mind, none of this should be considered financial advice. And it's Sunday, February 19th, 2023. And I hope your weekend was a restful one because Monday awaits. OpenSea made changes to platform fees and creator earnings to compete with other marketplaces, and these changes were significant. OpenSea's user base has been decreasing because of competition. These changes may help OpenSea regain some of its dominance in the market. The NFT marketplace Blur had more ETH trading volume than OpenSea did on February 18th. Nansen provided this data. Users want to make more money from their NFT investments. They think they can do this by using a different marketplace. Now, OpenSea has made 3 changes to keep its customers from leaving. These changes are a 0% fee for a limited time, optional creator earnings, and leniency for other operators. OpenSea hopes that these changes will be enough to stop customers from migrating to other marketplaces. OpenSea acknowledges that marketplaces don't necessarily enforce creator earnings and that this has led to a loss of users. OpenSea hopes that the new measures will make it dominant again. Now, Blur's decision to roll back creator earnings and to force creators to choose between liquidity on Blur or on OpenSea proves that OpenSea's previous attempts were unsuccessful. OpenSea claims that it protected creator earnings on all collections. It also supports operator filter. This feature helps creators earn revenue from the resale of their work. However, filter blocked recommendations for marketplaces with the same policies. That said, Blur has more daily trading volume than OpenSea, and that's because Blur has a different royalty payment policy. And so, while the two marketplaces feuded over royalties, members of the community spoke up. They highlighted the need for competition in the industry. So their point of view is, without zero royalty marketplaces, the big players like OpenSea could just increase their fees to the point where it becomes harmful to creators and collectors alike. Looking to the future, OpenSea plans to continue to test their royalty scheme. They're looking for something that balances the needs of the community with their own needs as an organization. One question is, will OpenSea start pumping their platform fees in the future, especially if they're successful in recapturing their market share? So for the last couple of weeks, U.S. regulators have been pretty busy, right? The SEC and the CFTC, cases against FTX and Binance. As we talked about last night, they're going after Do Kwon and Terraform Labs. And it takes a lot of energy and attention to choke the life out of an industry without the inconvenience of having to ask Congress to pass laws to do so. Now, don't get me wrong. I am the first to support reasonable, clear-headed, common sense regulation. I think that's something the industry needs. Unfortunately, a lot of U.S. regulators don't know what reasonable, clear-headed, or common sense looks like. Well, that's on our side of the pond. But what about the UK? Because it's been kind of quiet over there lately. Now, we talked earlier about rogue crypto ATM machines opening in the UK, even though nobody has the legal authority to do so. Some 20-odd machines, as I recall. At present, the UK's Financial Conduct Authority has flagged 51 companies. Now, these are unregistered companies serving UK citizens. Notice I said flagged. They haven't actually done much to them yet, that we know of, despite some of them having been on that list for approaching 2 years, which of course lands them in legal hot water, as they're supposed to be registered with the FCA. Supposed to be. James Aline serves in the capacity of legal director at Kinsley Napley. Now, he's a former FCA official, and he was talking about unregistered firms servicing UK clients. He said, quote, "I'm quite surprised to see the relative lack of action by the regulator against those firms. It has powers under the regulations to, for example, apply for court injunctions, to start criminal prosecutions, and I'm certainly not aware of those powers being used by the regulator at this point. But all of this is above-board actions. We don't know what could be going on covertly. They might be trying to build a bigger case. What makes it weird is how strict the Financial Conduct Authority is with handing out these licenses. They're so strict about who they grant licensure to, and then they flub up the enforcement part of the package. It just seems very strange to me and makes the UK crypto regulations look rather immature, to be honest. Not that the US is any better, but that's beside the point. And when I say strict, what I mean is the FCA had over 300 firms apply for registration. Only 41 of those firms made the cut. A lot of them quit partway through the process, and a bunch were actually rejected before the complete assessment was conducted, or they were rejected after the assessment. In any case, that's a rather large rejection rate for a financial regulator. The FCA can investigate and enforce UK money laundering rules. Operating without registration is illegal. The FCA can enforce financial services rules for other actions that it regulates, like collective investment schemes, additional services, or financial promotions. Crypto firms that break these rules can face enforcement action. Aline believes that additional action against 51 unregistered crypto firms is needed. The goal is to prevent criminal activity. They stated that the 51 unregistered firms may pose a higher risk of money laundering or terrorist financing. Supervision is necessary to prevent this. Registered firms are already supervised for these purposes. The UK's Conservative government supports digital assets. Prime Minister Rishi Sunak wants to make the country a hub for them. This has influenced the FCA's stance on crypto, making it slightly more open. The Financial Services and Markets Bill will pass later this year. The FCA will receive more powers as a result of this. The Finance Ministry is consulting on crypto rules. They want all crypto companies, including registered ones, to apply for new authorization. The aim is to update regulations. The FCA is monitoring crypto promotions. Companies who violate its new advertising rules may face a 2-year prison term. The FCA has already issued warnings about this. The FCA will crack down on bad crypto actors. It's not a matter of if, but when. Now, the timeline is unclear. But I do know this. The blame game has been strong in the UK over this very subject, because most of the crypto companies that attempted to register with the UK regulator had to either close or move. Many of these companies still serve UK customers from other locations. Proposed rules may prevent companies from serving UK customers from other countries, though. All crypto companies, local and foreign, will be required to register and set up locally. The rules are not in place yet, causing conflict between the regulator and the crypto firms. Crypto exchanges and custody providers in the UK must register with the FCA since January of 2020. They must follow anti-money laundering rules to serve UK clients. The FCA received 300 applications from crypto firms this year. And not only were only 41 of them approved, the FCA even reported some applicants to law enforcement agencies over the suspicion of criminal activity. Now, some firms that moved abroad are still serving UK customers. This goes against the aim of restricting unregistered firms from serving locals. Crypto companies may prefer a more relaxed regulatory environment. The FCA's strict requirements lead to firms moving away. Despite this, the FCA is still pursuing its goals. Now, companies that did not receive full FCA approval argue that the registration process was difficult. They faced long wait times and a lack of feedback. Some firms feel like they were treated unfairly by the regulator. Lisa Cameron is the chair of a cross-party parliamentary group for crypto in the UK, and she stated that some companies have given up and moved elsewhere. In an interview in January, she explained that these companies were large firms who wanted to do the right thing and engage constructively. Exmo, Globalbach, CEX, and Biddylicious representatives confirmed that their companies are serving UK customers from elsewhere. They made this decision after failing to register with the FCA. Now, FCA Director of Payments and Digital Assets, Matthew Long, said that the firms failed the registration process and they did not provide enough evidence of robust anti-money laundering and anti-terrorist financing systems. They said that the FCA is not responsible for the firm's inability to meet the standards. Harsh. The FCA claimed that they did collaborate with crypto firms to help them understand their expectations and to offer feedback on their application. Now, according to them, The fact that 39 crypto firms have successfully registered indicates that these standards are possible to achieve. Louise Abbott, a partner at Keystone Law, had clients who were scammed by at least 5 crypto companies that failed to register with the FCA. Now, Abbott said that many applications for authorization are rejected by the FCA due to entities being unable to comply with the regulatory scheme. But this does not necessarily indicate criminal intent. The FCA published tips and advice on January 26th for companies that want to get registered. They said that companies must have a detailed business plan that focuses on compliance oversight and risk mitigation, that they must have policies, systems, and controls in place to manage and mitigate risks. Crypto firms may face even more stringent rules with the proposed regulations open to public comment until April. The new rules would require companies that are registered with the FCA to apply for new authorization and go through more extensive checks. Now, one potential effect of all this has been a hit to the fintech industry, because we now know that investment in the UK's crypto and fintech industries decreased in the second half of 2022. Some of that was due to unstable macroeconomic conditions and high inflation. In 2022, there were 591 fintech deals in the region. This is compared to 724 the year before. KPMG published a report on Wednesday, and that report showed a $22 billion decrease in fintech investment in 2022, down to $17 billion. This report highlights that investor sentiment shifted due to geopolitical challenges as well as market turbulence, and that led to a lack of IPO exits and downward pressure on valuations. And if you look at it, the drop in fintech investment in the UK mirrors a drop in the total cryptocurrency market cap. In November of 2021, the cryptocurrency market cap was over $3 trillion, but by December of 2022, it was under $800 billion. Now, investment in fintech dropped as crypto fell. The first half of 2022 had more investment deals than the second half. Kareem Haji, a partner at KPMG, said that the change in the investment was due to a change in investor sentiment caused by geopolitical challenges, lack of IPO exits, declining valuations, and market turbulence. Payment firms in the UK received the most investment last year, sucking up $3.6 billion. Last year, over 6,000 fintech investment deals worldwide generated $164.1 billion. That's lower than the $238.9 billion in 2021. Investments in crypto and blockchain firms fell from $30 billion in 2021 to $23.1 billion in 2022. Value locked within DeFi protocols dropped from $180 billion to $50 billion. According to a report by Pantera Capital, VC investment in crypto companies decreased by over 75% from Q4 2021 to Q4 2022. Reuters claimed that Binance US moved $400 million from an American affiliate's account. Binance US has denied this report. Binance US said that only its executives can access its bank accounts. Now, Reuters released a report on February 16, 2023. This report stated that Binance moved $400 million from a Binance US bank account to a trading firm called Merit Peak. This transfer happened in Q1 2021. The trading firm's manager is Changpeng Zhao, also known as CZ. Now, this is a problem for Binance because CZ is the CEO of Binance. Binance US issued a tweet statement. It said that the report was incorrect and outdated. Binance US confirmed Merit Peak's existence, but it said the firm stopped operating on the platform in 2021. Only executives of the company could access its bank accounts, and they said Binance US does not trade or lend consumer funds, that it always maintains one-to-one reserves. They said that regular audits and regulatory reporting happen by government entities. Binance US has former employees from the top US watchdogs on its leadership team, and they ensure compliance with US laws and regulations. People at Binance US say that they were unaware of the transfers mentioned in the Reuters report. Messages showed that the US executives did not know about the outflows. Binance does not have a license to operate in the U.S. Binance US is an independent entity of the international platform. The transfers suggest a commingling of funds. At present, we don't know if that money belonged to Binance US customers. Now, Merit Peak was investigated by the SEC in February of 2022. That investigation was due to its ties with Binance. Binance has been under regulators' radar in recent years. Binance recently admitted to lapses in regulatory compliance, and Binance said that it's willing to reach a settlement with U.S. regulators. And that's going to do it for us on a Sunday night. I want to thank you, my listeners, because when you stop listening, I will stop talking. If you enjoyed tonight's show, please like, follow, subscribe, leave a rating or a review. And in the meantime, we'll see you tomorrow night.